All right. This is a chart of accounts, and it's a brief chart of accounts, but it's exactly what virtually any company will do. So every account in an accounting system has a number, and generally the first digit, if we're dealing with 3 digits or 4 digits, is indicative of the type of asset. So in this particular system, account assets start with 1, liabilities start with 2, and then equities start with 300 or higher. Right? If we have a 400, we know that's a revenue, and if we have a 600 numbering, that's an expense. Now, not every system uses these. This is just offered as an example of a common numbering scheme. All right. So we want to really internalize the concept of debits and credits. So there's a good chance that you already have kind of a preconceived notion of what debits and credits are. All right. So I will ask you to check that at the door when you come to your accounting class, because it will confuse you. All right. From our perspective, debit means, if you think of an account, this is what we'll call a T account. All right. From our perspective, debit means an adjustment to the left side of the account, and credit means an adjustment to the right side of the account. All right. Now, a lot of times you'll associate credits maybe with an increase, debits with a decrease. You have a debit card, you have a credit card. All of those have meanings that are confusing if we apply their meaning outside of accounting to this course. So for our purposes, debit means left, credit means right, right? And we need more information to really attach any additional meaning to that. And so here's our accounting equation again. This should look familiar, but it's expanded out a little bit with T accounts for assets. All right, so the word normal is, if we look at the accounting record, we would typically expect to see a debit balance for any asset account. All right, there are some exceptions that we'll get to, but for now, assets, we would expect to see a debit balance. And the normal balance is the side that serves as an increase for that account. All right, and we'll work through this. I'll demonstrate this and give you guys an opportunity to work through it as well. On the other side of the equals, for liabilities, normally if you look at a liability account, you're going to see a credit balance. So the normal balance for a liability is a credit, and we increase liabilities with credits. All right. Similar goes for equity. All right. We can expand this out a bit further and add more detail to the equity account, because equity is composed of common stock, dividends, revenues, and expenses. All right. So we'll note that dividends and expenses have normal debit balances. All right. And that's why they have minuses in front of them, because they reduce the equity account. Again, this is in the abstract. We will put concrete application to this in class. All right. Let's talk briefly about the trial balance. All right. So when we prepare a trial balance, it's going to look like a financial statement. It's going to look like a balance sheet, perhaps, but it's not. All right, it's just a total listing of every single account in an accounting system, and the balance, or I should say, at the end, total debits in the system should equal total credits. In other words, if you subtracted total debits from total credits, you're going to get 0. All right. That's the trial balance. We'll work through this so you guys will get to see it in action. What is the purpose of a trial balance? Actually, so really the purpose of the trial balance is it's an interim step done before you prepare the financial statement. So this slide should look familiar. We saw it in chapter 1. These are your 4 basic financial statements. And I won't go, well, yes I will, because it's good to hear. But you would prepare a trial balance before you prepared your income statement. Income statement, revenues less expenses, giving you net income. Income statement, revenue less expenses, giving you net income over a period of time, most commonly a year. Statement of retained earnings. It's a roll forward, so it starts with retained earnings at the beginning of the year. You're going to add net income or subtract net loss, subtract any dividends paid or owner withdrawals, and you'll get to ending retained earnings. All right. Balance sheet. That is the accounting equation personified as of the income statement date. So if the year ends December 31st, the balance sheet's going to be dated December 31st. All right. Every single asset added up, every single liability added up, every single equity. Add total liabilities and total equity, and they should equal total assets. All right. Statement of cash flows. I went into the theory behind that in chapter 1, so we can kind of stick a pin in that because it doesn't come back until later in the term.